Ever wondered how people make money from the stock market? It might sound complicated, but today we're breaking it down into simple, easy to understand pieces. By the end of this video, you'll understand what stocks and dividends are and how you can use them to build wealth over time. So let's start with the basics. What is a stock? Imagine a big pizza. A stock is like a single slice of that pizza. When you buy a stock, you're buying a tiny piece of ownership in a company, whether it's Apple, Amazon, or your favorite coffee shop if it's publicly traded. This makes you a shareholder. As a shareholder, you're not just a customer, you're a part owner, and you get to share in the company's successes. Now, how does owning that slice of pizza or stock actually make you money? There are two main ways. The first is called capital appreciation. This is simply when the price of your stock goes up. If you buy a stock for $10 and its price rises to $15, you've made $5 per share in capital appreciation. You realize this profit when you sell the stock. It's the classic buy low, sell high strategy. But what if you don't want to sell? That brings us to the second way to make money, dividends. Dividends are the main event of our video today. Think of it this way. When a company makes a profit, it has a choice. It can reinvest all that money back into the business to grow, or it can share some of that profit directly with its owners, the shareholders. That shared profit is a dividend. It's like a thank you bonus for being an investor. So what are dividends really? They are regular payments, often made every quarter, from the company directly to you. It's real cash that lands in your investment account. Not all companies pay dividends, though. This leads us to an important distinction: growth stocks versus dividend stocks. Growth stocks are typically shares in newer, fast-growing companies. These companies usually reinvest all their profits back into the business to fuel expansion, research, and development. They're focused on growing as quickly as possible, so they don't have extra cash to pay out as dividends. Investors buy these stocks hoping for significant capital appreciation, that the stock price will skyrocket. On the other hand, dividend stocks are usually from more established, stable companies. Think of big names in industries like utilities, consumer goods, or banking. These companies have consistent profits and don't need to reinvest every single dollar to grow. They've reached a point where they can afford to reward their shareholders with a portion of their earnings. These payments provide a steady stream of income for investors. Why would a company choose to pay dividends? Firstly, it's a sign of financial health and stability. A company that can consistently pay and increase its dividends is showing the world that it has a reliable business model and steady cash flow. Secondly, it attracts a certain type of investor, those who are looking for regular income and long-term stability, rather than just quick growth. It's a way to build a loyal shareholder base. Now, you might hear the term dividend yield. This sounds technical, but it's a super simple and useful concept. The dividend yield is a percentage that shows you how much a company pays in dividends each year relative to its stock price. To calculate it, you just take the annual dividend per share and divide it by the stock's current price per share. For example, if a stock costs $100 and pays a $4 annual dividend, its dividend yield is 4%. This helps you compare the income potential of different dividend stocks. One of the most powerful strategies with dividends is reinvesting them. This is often called a dividend reinvestment plan, or DRIP. Instead of taking the dividend cash, a DRIP automatically uses that money to buy more shares of the same stock. This might not sound like much at first, but it creates a snowball effect. The new shares you buy will also start earning dividends, which then buy even more shares, and so on. This is the magic of compounding, and it can dramatically accelerate your wealth growth over the long term without you having to lift a finger. Of course, investing always comes with risks, and stocks and dividends are no exception. The biggest risk is market risk. Stock prices can go up, but they can also go down. A company's value can fluctuate due to economic conditions, industry trends, or company-specific news. This is called volatility. Another risk specific to dividend investing is that dividends are not guaranteed. A company can decide to reduce or even eliminate its dividend if it runs into financial trouble. That's why it's crucial to invest in strong companies with a long history of paying and growing their dividends. So how do you navigate these risks? The key is a long-term investing strategy. The stock market is not a get-rich-quick scheme. It's a tool for building wealth patiently and consistently over years, even decades. Don't panic during market downturns. History shows that markets tend to recover and grow over time. And don't put all your eggs in one basket. Diversification or spreading your investments across different companies and industries is your best defense against risk. If one of your stocks performs poorly, the others can help balance it out. If you're a beginner, here are a few simple tips to get started. First, start small. You don't need a fortune to begin investing. Many brokerage platforms let you buy fractional shares, so you can start with as little as a few dollars. Second, invest regularly. Whether it's $50 or $100 a month, consistency is more important than timing the market. This strategy, called dollar cost averaging, helps smooth out market ups and downs. Finally, focus on quality. Invest in companies you understand and believe in, companies with strong financials and a history of treating their shareholders well. To recap, buying a stock makes you a part owner of a company. You can make money from the stock's price going up, capital appreciation, or from receiving a share of the company as profits, called dividends. Reinvesting those dividends can supercharge your growth through compounding. While there are risks, a patient, long-term, and diversified strategy can help you build significant wealth over time. Investing is a marathon, not a sprint. The most important thing is to get started, stay consistent, and keep learning. The journey to financial freedom begins with that first step. Thanks so much for watching. If you found this video helpful, please hit that like button and subscribe for more simple guides to investing and personal finance. Let me know in the comments if you have any questions. See you in the next video.